Well, good morning, and I guess happy February 15th. I think I said this last week when we were getting together for these, that it's just hard to believe that we're into February. Now it's hard to believe that February's half over, I guess, if you look at that. So we're straight up into the tax season, and obviously that's what we do here with these live streams is really try to keep the conversation and dialogue going. We check in with the National Tax Group. We get different insights and bring it to you, and really in a way that you can ask your questions in real time. And these sessions, like I've said before, are really for you as the audience member, so we can see what's on your mind. But yeah, tax season is really kind of into full swing now. And so I'm excited today we have Yelena joining us as she often does, but we also have two new to the, I guess, Simply Tax Talks. We have Tug Playlar out of Houston. He's going to be sharing some industry insights with us today. So welcome. And
Thanks, Damien. Glad to be here.
We've got Craig Kuchenberg standing in today too, from our National Tax Group, works closely with Yelena and coming from our Indianapolis office. So welcome, Craig.
Well, thank you. Great to be here.
All right. So as we usually do, let's just jump right into our top tax topics for the day. So Yelena, it's probably almost like the questions each week. It's what's going on and what are you watching? So what happened in the last week since we spoke?
Yeah, well, there's been no real progress on the BBB front. Everyone's still kind of just putting some quotes out there and saying they're open to negotiation. But a lot of the focus this last week has been on the recent release of the inflation numbers. The White House and some Democrats are saying that the BBB is the answer to manage inflation because it would help cut costs of prescription drugs and healthcare. Meanwhile, you have Manchin, who keeps saying, you know what, I disagree. I think more spending in light of rising inflation is a bad idea. But in an interesting development, Manchin did say last week that if negotiations restarted officially, he would support a 25% corporate tax rate, a 15% minimum rate, a capital gains rate increase to 28%, and then elimination of carried interest, which is interesting because Senator Sinema has said that she won't vote for any bill that has corporate and individual tax increases. So that basically starts negotiations at a stalemate because Manchin's vote to pass this in the Senate. And so it's kind of an interesting development where it kind of feels like we're back to square one where we were a couple months ago when we did have these rate increases in some versions of the BBB in the past. And they were taken out to please Senator Sinema. And now you have Manchin saying, you know what, I kind of want those back in now. So that was an interesting development. But while there's been no progress on the BBB front, Democrats and Republicans have agreed to a general framework to fund the government through the end of FY 2022, which is good news because they've been passing stopgap measures month to month, basically since October. But they are going to pass another temporary stopgap funding measure to fund the government through March 11th. And the reason for that is this gives them a few more weeks to finish negotiations on some expired or soon to be expiring energy tax provisions that are going to be attached to the spending bill. And so generally Congress waits to negotiate these tax extenders last when they consider the annual spending bill, because it's a good way to secure last minute votes. So it's more of a negotiation tactic that they use. But this time it's a little bit more complicated because some of these tax extenders and energy credits are also in the proposed BBB plan. So now that's kind of become almost a game of Tetris of trying to figure out which of these tax extenders are going to be included in the annual spending bill and which ones are going to be left on the table for BBB negotiations. And so these next few weeks, that's what's kind of something to watch for, is to see just kind of where Congress goes and what's being negotiated into this current spending bill and what's going to be left on the table for the BBB.
I like, I don't know, I'm a big Tetris fan. So I don't know, when you say Tetris, I'm like, yeah, that's an interesting metaphor, but it fits really well. So I'm wondering, I didn't hear you say anything about what maybe Senator Sinema is feeling kind of back on the points that Senator Manchin was mentioning as, being open for discussion. So I assume that means we just don't know. So maybe, like you said, back to square one. Is that a fair way to look at it?
Yeah, I mean, we haven't heard anything from her. At least I haven't seen any official quotes from her, but she had a pretty firm stance last fall when this first came around that she was not going to vote for anything that had corporate or individual tax rate increases, which is where the minimum tax was introduced. The 50% minimum tax is kind of a way to get around that. And so Manchin does support that. So I guess that's kind of one common ground for both of them. But Manchin also wants to see other rate increases to offset some of the spending. Again, he's worried about debt. He's worried about inflation. And so we haven't heard that Sinema changed her mind, but she was very firm on this last time when they were negotiating in the fall, that she was not going to vote for any tax rate increases.
Right, exactly. So it kind of just again makes you wonder. The thing we've been talking about all along, right? We're kind of threading a needle here because the vote count is so close. So yeah, just very interesting to see. But are there any other, I guess, pieces of legislation or topics of legislation that are maybe floating about on the Hill right now?
Yeah, well, something that I want to mention because Tad isn't here, it's one of his favorite topics, is an employee retention credit. So, as we know, it expired the end of Q3 of 2021, but a coalition of 5 Senate Finance Committee members introduced a bill called the Employee Retention Tax Credit Reinstatement Act last week. And the goal of that bill is to reinstate the employee retention credit for the fourth quarter of 2021, just because I think politicians have been getting a lot of calls from tax practitioners and businesses and just their constituents saying, hey, it's not fair because the credit was available through the 2021, and then it was kind of retroactively ended. And so a similar version of this bill was introduced in the House in December. And so these proposals have also been backed by 70 organizations representing charities and businesses, and just getting a lot of bipartisan support both in the House and the Senate. And so it's an interesting development where, again, it would be kind of a retroactive bill, but it's something that's kind of getting traction, surprisingly, both in the House and the Senate and just in the overall business community as well. So that's something to watch, perhaps, that could be coming down the line.
Yeah, that'd be interesting too, just by the nature of the dynamic too, that, we're working on 2021 tax returns for most calendar year taxpayers right now. And there's a deductibility issue, right? Because we don't get to deduct the wages if we use them for the employee retention credit. So that could be an interesting dynamic. But I mean, any sense, because I mean, obviously this would have a kind of a spend component to it. Is it too soon to know maybe how that might come about? Because again, I would assume either there's some sort of an offset, or again, there's going to be a price tag. So any word on that, or any guesses, I guess, onto what we might see there?
Yeah, I think at this point, anything's up for negotiation. I mean, they are negotiating the annual spending bill, so I haven't looked into the exact procedures where if it could be attached to that, but I think they are feeling the pressure from their constituents to do something about this because, again, it was available, then it wasn't, and then you have this complication of, well, if you do make it available again, there's all these other issues to consider, and if you do make it available, then you have to do it sooner than later, and so it's kind of a tricky because politically you can sell this, but from like a practical tax compliance perspective, that's a little bit harder. And like we talked last week, Congress generally tries not to change tax policy for the year that's currently under the IRS. And so again, it's a balancing act. So it'll be interesting to see, because if they want to pass this, they have to pass this soon. And they really can't wait to, like, for example, put this back into BBB negotiations, because that's going to take too long. And so I think it's just kind of a wait and see. And I think in the next week or two, we'll see if it gains traction not to actually be passed.
Interesting. Yeah, it will be very interesting to watch that one for sure. And I know there's many that would be very interested in it, in addition to it being interesting, I guess. So, well, thank you, Elena. Like you said, there's just always so much going on, and it's always hard to know where it's going, but at least to be able to have your insights as to where things might be heading and what we're hearing is so helpful. So I guess next I want to kind of turn to talk here. You have a great perspective on the manufacturing, distribution, logistics space. I'd say great perspective overall. I'll pay you that compliment. And so I wanted to check in with you. We're going to do some industry insights here, maybe in our next upcoming sessions of the live stream. So I guess from your perspective, having just given you that kind of that background there, what are you seeing? What are the questions or the topics that are coming up, or the things that you're bringing up to your clients that you're working with?
Sure. Really, the biggest question my clients have been asking me is, where's my refund? Where's my cash? We did a lot of work with NOL carrybacks, employee retention credit, and the IRS is just not quick to refund right now. All of our clients we were all excited about the PPP loans and ERC, NOL, tax changes, but most of the ERC stuff I just haven't seen. So the clients are really getting anxious. But, with the IRS shut down during COVID, they've been distributing stimulus checks and child tax credit advances. So they've really been short on resources.
Yeah. Sorry, I get the microphone stuck. It wouldn't be a live stream if you don't get your microphone stuck on mute, right? But yeah, that for sure has been a concern. And actually, it's interesting as Yelena was talking about the employee retention credit. I don't know if you're hearing this one. I hear it quite frequently of where's my ERC refund? Is that a frequent topic of conversation that you're seeing?
Right. So the clients are really planning on using that cash. So we've done the work, they've seen the numbers, and they're not small numbers, right? I mean, we've gotten the maximum amount of refund back for all our clients, and the IRS is just really struggling. I don't know if you've seen the um, recent information they've posted about the IRS, but they're reassigning 1,200 employees through September to deal with the backlog, and just some of the numbers, it amazed me. They have 6 million as of the end of the year. Back in December, they had 6 million unprocessed individual returns, over 2 million unprocessed amended returns, and 5 million pieces of correspondence from the taxpayers that were still not processed. So, for our clients, cash flow is key. So hopefully with these, the 1,200 IRS employees getting reassigned, they'll be quick to get some cash in our clients' hands. And so it's been a little discouraging for the clients, right? But I think hopefully there's a light at the end of the tunnel. To Yelena's point that there could be an additional fourth quarter ERC. So hope for all the best. But just even the call log is kind of ridiculous on the IRS side, right? And in 2019, 2020, they had 100 million calls, which they answered 20% of those, and then in 2021 they had 280 million calls, and they only answered 11% of them, which was still 32 million calls, but they don't have the bandwidth to do that. So hopefully we see a bounce back this year, especially.
Yeah. I know you're a pretty popular guy there, so you probably get a similar number of phone calls, but I just mentioned that. But no, Craig, sounds like you had a question there. Go ahead.
Yeah, no, I was just going to add on to what Tug was saying, just the frustration, especially with these ERC refunds, where Damien, you mentioned earlier that taxpayers have to reduce their payroll deduction for the amount of the credit, and it's in the year that the payroll is earned and paid. So you have taxpayers now approaching April 15th and having to pay a higher level of tax because they lost the deduction for the amount of the credit, but they haven't got the cash from the credit that would hopefully help pay some of that additional tax liability. So it's definitely a frustration for taxpayers.
Yeah, that's a great point. And I just had that conversation earlier this morning, in fact, around like how are we going to approach that and whatnot. So, I guess there is a question that we got here from the comments, and so there's obviously talking about retroactive components here, and we've talked about it too with some of the things like the SALT cap fix and things like that. But I would imagine, and I guess maybe I'll let any one of you, maybe Elaine, I'll go with you first, and then the other two you want to chime in as well. But how would a retroactive change like the ERC, for example, alone impact the filing season? I mean, it probably can't help, I guess. Yelena, what do you think?
Yeah, well, I mean, that's something we've been talking about here the last few weeks, because we've had a few quotes come from mostly Senate aides, and so the senators or the representatives saying that they are taking all this into consideration, and they are aware that it's bad tax policy to pass retroactive changes, and they try to avoid that, but they did leave the door open, saying that they are, I think the quote was like a good balance of retroactivity. So they did leave the door open to say that there is an option to make some of the provisions retroactive, but they didn't really indicate which provisions. And so, again, I think it's a balancing act for Congress to consider, how much you want to make retroactive and which provisions. And so at this point, we don't have an idea which one it'll be or which provisions it'll be, but it is something, again, to keep an eye out on as negotiations continue.
Absolutely. So, hey, Doug, I'll go back to you, and maybe we kind of get almost the industry perspective. As Doug's mentioned here in this comment, that right there's just been a lot of changes, a lot of things that have changed. We're heading into working on these 2021 tax returns, moving into 2022. What are you hearing from kind of just different, I guess, industry perspectives? Maybe starting in the manufacturing space.
Yeah, so really it's a lack of resources, right? So it's not just the IRS that's having a lack of people, but you look at the supply chain, and then there's a big backlog, right? So again, our clients like to have backlog, but they also like to deliver, on their current projects, right? So I was talking to a client yesterday, and they have a big construction project they want to get done, which would normally be a 6 to 8 month project that they started now. And it's the people out there, the different companies are saying, well, number one, we can't start it yet, we don't have the employees. Number two, um, you know just the resources to build something like that, it's so estimated out to 2 years instead of 6 to 8 months, right? So you're looking at a timeline of how can we grow this business with this constrained resources. And so that's, again, you want to be able to run your business as smooth as possible. So I think there's a lot of hiccups coming up because of the supply chain, right? So I mean, look at, you can go over to trucking, right? Trucking, everything I hear is they need more drivers, and that's not a new slogan. Everything they've ever said in trucking is we need more drivers and we need good drivers. So
Uh-huh.
that's something they're dealing with. They're trying to change, industry specific for trucking. They're trying to change the age for interstate drivers from 21 to 18, right? I mean, you look at someone coming out of high school that doesn't necessarily want to go to college, and they want to, in Texas, it's a little bit easier. Texas is huge. So you could be a truck driver in Texas without having to leave the state and make plenty of money. But, some of these other smaller states, these 18, 19, 20-year-olds can't leave the state. So and again, safety is the concern as well. But so they're trying to fight that. So to try and help that resource pain right now. But I think we're going to see it going forward until we correct this somehow.
Yeah, and this is, I mean, it's all tax related, right? I feel like, because at the end of the day, I always say if you don't have revenue, you don't necessarily have a tax concern. So you want to make sure we're thinking about the whole business. But I don't know, do you have any tips or best practice that you're seeing clients doing around the kind of the people and the resource issue at this point in time?
Well, they're spending money trying to get the right people in, right? Just like all of us, right? Anytime we have a resource constraint, we try to fix it the best way possible. Sometimes you have to throw some cash at it, but you go through and to your point, you look on the tax side. If we could get this cash back, we could throw some more cash at it and hopefully improve the situation. But I think everything I'm hearing is hopefully by the end of 22, the supply chain is a little bit back to normal. So I guess we're gonna hold tight and do what we can do until we get there.
Yeah, and I guess speaking of that, there's we're in this inflationary period. I heard you mention that, right? And cash flow, obviously, there are some tax planning things that we can do around cash flow and helping with that. But anything specific, I guess, that we can, I guess you've been talking about relative to maybe inflation or methods in general?
Yeah, so the ERC, we talked about that a lot. Just because it's passed doesn't mean you can't go back and amend. So if somebody missed out on that, that's free money. We should go back and get that. And something new, I guess in 21, 22, where restaurant meals were 100% deductible, and then bonus depreciation, right? We have some bonus depreciation changes coming up, and then accrual to cash conversions, right? So if you're under the 26 million gross receipts test, you can switch to cash, and hopefully that would help your tax situation going forward.
Yeah, absolutely. So we'll come back to you in a bit on a few other things and closing thoughts, but let's head over to what we'll call Craig's Corner here to ask a few things of him. I can't resist, I like alliteration here. We've got Tad's Takes and we got Craig's Corner. So Craig, we're talking about methods and whatnot. I know we've had a little bit of a conversation coming up around LIFO, or last in, first out. Actually, it came up on our most recent episode of the podcast, even in passing. Anything you would add there? And maybe feel free to join in as well, because I know you've been following this one and seeing a lot in the space as well.
Well, thanks, Damien. I'm honored to have a title to my section. I didn't know that Craig's Corner was coming.
Hey, throwing that in there, got on the fly.
But yeah, definitely, LIFO isn't last in, first out. Inventories isn't a new topic per se, but with all the inflation going on right now, it's definitely becoming more popular, definitely worth a consideration. And so, I mean, the theory is that with last in, first out, you're selling goods to customers based on their most recent cost. And so if there's inflation, significant inflation, then the cost of the most recent good you produced or you acquired for wholesaling and distributing, that's going to be a higher cost. That's going to be more deduction from your cost of goods sold, and help reduce your tax liability currently. So, maybe a quick example is if it's your first year as a car dealer, and so you buy 10 cars, and you buy them for $100 each, and then you sell them, and then you have 10 more cars that you purchase at $150 each because of inflation during the year. Well, under your FIFO costing, you'd have $1,500 in ending inventory, $1,000 deduction, because the first one you sold cost you $100 each. But in the LIFO regime, you'd be deemed to be selling the 10 vehicles you purchased last or most recently, and that was with $150 of cost, and so you'd have a $1,500 deduction. And so just kind of a simple example. So definitely when we're talking with clients and when it was experiencing a significant amount of inflation, it's definitely worth a discussion to look at if you're currently on FIFO, switching to the LIFO method. I know it adds some complexity because with FIFO, it's easier for taxpayers to know what their inventory balance is, what their cost of goods sold is going to be for planning purposes. And with LIFO, you may not be able to fully compute what your ending inventory is and what your tax deduction is going to be until maybe later in the year or after year end. But the benefits can be significant, though, especially in a year like this year where there's just been a significant amount of inflation. A couple things just to keep in mind, though, is that if you are going to use the LIFO method for tax purposes, you have to be consistent and use that LIFO method for book purposes and what you provide to the bank. So if you're going to go and make this election for 2021, you need to be thinking about that soon, because if you're issuing your financial statements, if the bank audit's required at the end of March, you need to coordinate and be consistent with book as well. So, but you do have the option to elect to be on the LIFO method for 2021 all the way up until the extended due date for the tax return. So it's not an election that you would have to have done in 2021.
Yeah. Now, I guess, so anything you'd add to that? I mean, you seeing in practice, or you implementing, or concerns or questions that come up from those that are looking to implement it, perhaps?
Yeah, so on our dealership side, right, most car dealers are already on the LIFO method, and so kind of a reverse look at it. They're looking to say, hey, should we switch to FIFO and kind of take that 4-year spread over a 481 adjustment? And it just depends on the dealership, right? So I have one client that is looking at it saying, hey, I want to recapture everything, pick up as much income as possible now, which is not the normal train of thought, because they think that tax rates are going up, right? So they're going to gamble and say, let's pick up as much income as possible. Where I have other dealerships saying, hey, let's switch to the FIFO now. Our inventory going forward is going to stay low, and so let's spread out that income over 4 years so we don't have to take the big hit this year. So the National Association of Auto Dealers is really lobbying for relief under Section 473 for LIFO participants, which basically says you have up to 3 years to increase your inventory and stay on LIFO to where they're not getting that big hit as well. But we're patiently waiting to see if that gets put into law or some sort of implementation of 473. So,
yeah, very interesting. Yeah, and then we've got a poll question up here right now too around whether or not you've considered a change of accounting methods, because it is, it's interesting you say that, right? To maybe switch the other way, even in this environment, because you're right, you're usually trying to go the other way to reduce, but maybe you think the tax rates are good now, or like you said, there's a number of reasons you could look at doing that. But accounting methods are pretty valuable way to do it. So yeah, curious what the group thinks, but I don't know, any other, I guess, considerations from the accounting methods front, either from you, Tug, or Craig?
Well, I think Tug's last point was a good one in that, a lot of times we're always trying to accelerate expenses with these accounting method changes. But we have had some clients and taxpayers are certainly looking at, do I want to take bonus depreciation this year if I expect rates to go up next year? And so, we've seen where, some have kind of made the bet a little bit that, we think rates are going to go up. We don't think they're going to go down at least. So, we're going to maybe elect out of bonus depreciation or save an accounting method change to accelerate expense until rates do go up. And thinking maybe worst case scenario, they're out time value of money on the, paying tax earlier than you needed to. But if the bet is right and tax rates go up, they might have saved 10%, let's say, on pushing that deduction forward. So, there's definitely a lot of accounting methods out there to consider. Tug had mentioned the accrual to cash one for taxpayers, small taxpayers under 26 million receipts. You can, that same rule applies. You can, there's 263A capitalization for inventory. You could elect off of that if you're under 26 million, so to accelerate some expenses. But another one, we're seeing a lot of accounting method changes, and this goes back to kind of the retroactive nature of tax law that we're seeing right now is qualified improvement property. There was an issue in the Tax Cuts and Jobs Act where it wouldn't qualify for bonus depreciation. They later fixed that in the CARES Act in 2020. So it's not too late if you haven't gone back and adjusted to some of those 2018 and 19 editions where you didn't take bonus depreciation on those. You can use an accounting method change to kind of catch those up. So that's another popular one we're seeing.
That's a great point, Craig. And there's a lot to think about. And again, I just go back to Doug's comment in the chat here earlier about the fact that there's been so many changes, even just going back to the TCJA changes and some of those and how that's impacting now, even with the bonus depreciation percentage starting to kind of ramp down in 2022 and so forth. So yeah, there's just a lot, I guess, to think about. But kind of what I'm hearing here, and I feel like we could go on for the better part of the day here, right, and talk about these things. But I guess I would encourage our audience members, we've got the contact information for everybody here, so please reach out, but especially with Craig and Tug, because they've got just great perspectives around LIFO accounting methods, how it works, what you should be thinking about, because I think sometimes it's specific to your fact pattern. I guess, would you both agree with that? Yeah.
Definitely.
All right, well, let's get our top takeaways for this week's session. All right, so we'll get our typical question of do we think we're going to see anything enacted here? So let's start with that. Yelena, where are you at? How's it changed? So we're just going with any provision from the BBB that's kind of resurfacing in a different form. What are your odds? We'll go with before the election that we see some components of them make their way into some sort of enacted legislation.
Well, I think something has to pass before the election because you have Democrats, a lot of them seeing falling polling numbers, and polling numbers drive a lot of legislation. And so I think just for that purpose, a lot of Democrats are almost desperate to pass anything at this point, even if it's something small. But again, even with that, they are still so much, they can't come to an agreement on anything. And to get 50 votes in the Senate, even for the most basic, simple things that they allegedly all agree on, has been almost impossible. And so you have these kind of competing tensions of like, we need to pass something, anything. And then once they actually start negotiating, it just falls apart. And so I think it's something, again, to watch and see if they can get around and make it work. But at this point, again, like we talked about earlier, we're kind of back at square one because all the negotiations that happened these last few months, since like last summer, last fall, are kind of just been wiped away. We're kind of back starting with nothing. And so, I don't know. It'll be interesting to see. I think it's possible before election, but it'll probably be something much, much smaller scale than what we originally thought when the BBB became a thing.
Okay. All right. So you're sticking with there's a chance. So again, these are just our personal opinions, I guess, right? Because obviously the crystal ball, if we had that, then we would have known the outcome of the Super Bowl on Sunday, for that matter, right? But Todd, what do you think? We're going to see some tax change enacted here before the election?
My gut tells me we're not going to see anything, but I tend to agree with Yelena. They have to pass something. I just think it's going to be a watered down version. They're gonna pass a few things just because they need to. So I don't have really too much to add, but I agree with Yelena. We'll say that.
All right, we got to vote yes for Yelena's take here. So, Craig, how about on your end? I guess your corner over there.
Yeah, it just seems right now it's just difficult for the Senate to agree on anything to get that 50 vote approval. So, but again, like Tug and Yelena said, it seems like they're going to need something to when they go out to before the midterms to lobby for votes, to something to tout, and here's what we did. So you think there'd have to be some sort of like watered down version that Tug mentioned.
Right. Well, I guess we'll see where it goes. But one thing's for sure, we'll be back again next week at least to kind of give more updates and check in, get up more industry insights. I want to thank you all for watching from home. I want to thank our panelists, if we want to call it for a panel here, Tug, Yelena, and Craig. I appreciate you even entertaining my titles that I come up with here. So, but no, great insights. And I would encourage you, if you're watching from home, watching from wherever you are, the office, wherever you find yourself today, reach out. Again, contact information's in here. And also, if I have one ask for you, it'd be to drop us an email. It's BKD or simplytax@bkd.com. And just let us know what you think. If there's topics you want us to cover, if you think we should keep doing these, change these. Again, really our goal here is to provide it on demand so you can get it in real time, and also, I guess, on demand after, right? And archive all of them. We've got the link to the website there where we've been archiving them as well. But let us know what you think. That's my ask of you for this week. But I guess until then, have a great week, have a great day, and we'll see you all next week for Simply Tax Talks.